So we will now look at some of the common benefit plans and their actual valuation requirements after having looked at the role of the managements that the management can play in the entire valuation process. See, before we actually look at the type of benefit, it is also important to identify the conditions on how the benefits can actually qualify for an actual valuation. The primary condition that the benefit plan must fulfill to qualify for the valuation is to check whether the benefit offered is allowed to carry forward to the future years. That is, the benefit is not utilized in the current year and must be allowed to take forward to the next year. Secondly, the benefit must be accumulating in nature. Given the broad variety of benefits that an organization can offer to their employees, the benefits are categorized under the four heads as defined in the accounting standard. First one is the post employment benefit plans, which could either be defined contribution in nature or defined benefit in nature. Actual valuation requirements is usually non-negotiable for defined benefit plans, something like end of service benefit, wherein the risk is completely on the employer and the benefit continues to accrue depending upon the service. Secondly, the other long-term employee benefit plans. Again, the valuations are non-negotiable for these category of plans. It includes the benefits like on leave, which are generally accumulating in nature. Also, because of a fact that earned leaves are allowed to be carried forward in future in case the leaves are not completely utilized in the current year. The next are the short-term benefits. These usually include the sick leaves or casual leaves, which are generally not allowed to be carried forward to the future years, means they are non-accumulating in nature. Hence, these benefits do not generally meet the requirements of the actual valuations. The next are the termination benefits. And again, the valuation requirements are generally varying depending upon the scheme policies for the termination benefits. So up till now, we have majorly covered all the items related to the actual valuation process. Now, in terms with the actual valuation process, we will majorly focus on the key element process, which are going to be first the data, second assumptions, third valuation methodology, and how to read, understand, and analyze the actual valuation results. In the entire process, the key focus is always to collaborate with the clients to understand what their objective and what their plan is. So now I'll request Arzu to take over and help us walk through the entire actual valuation process.
Thank you, Puneet. Very well spoken. And good afternoon, everyone. Hope you are finding this webinar insightful. So far, we have looked at the actuarial valuation process and how it involves analysis, modeling outcome, and ongoing monitoring. But one of the most critical aspects of any actuarial valuation is the quality of data we begin with. Actuarial valuations are highly data sensitive, meaning the quality of data directly impacts the accuracy of liability figures. Hence, a thorough validation process is essential. This process is built on three key pillars. First pillar is the data completeness. Every data set must be comprehensive, capturing all the required fields. For example, in an EOSB valuation, the data set should include details for each active employee as at the valuation date, including date of birth, date of joining, applicable salaries, and there should not be any missing or duplicate entries. The second pillar is accuracy of data. Now, even if the data is complete, errors in formatting or incorrect values can lead to distortions. To ensure accuracy, data must be correctly structured. For example, salary details should be precise, with all the relevant components included as per the benefit being valued. Now, the third pillar is reasonableness and consistency of data. This is the final step to validate whether the data aligns with relevant trends and assumptions or not. To give you an example, let's say minimum and maximum age of the employees should align with your HR policies and industry norms. Similarly, date of birth and date of joining should be consistent with data submissions you have done to your actuary, say last year. Then salary increments should be reasonable based on the past trends. Now, here the data quality matters significantly. Poor data quality can compromise even the most sophisticated actuarial models, leading to unreliable results. Hence, conducting data checks before valuation prevents such errors. This step is not just a compliance requirement, but a financial necessity. It strengthens credibility in financial reporting and reduces audit queries. Now let's talk about the actuarial assumptions. Actuarial assumptions form the foundation of any valuation. These assumptions help project future obligations based on available data and are influenced by historical trends, economic conditions, and organizational policies. To be effective, actuarial assumptions must be realistic, research driven, and regularly reviewed to reflect changing circumstances. Now, actuarial assumptions fall into two categories: financial assumptions and demographic assumptions. Let's delve into the details. Financial assumptions are the assumptions that relate to economic factors affecting valuation calculations. Key assumptions here are discount rate assumption and salary growth rate assumption. Discount rate assumption is used to determine the present value of future benefits, and salary growth rate assumption reflects expected salary increases over time, which is influenced by industry trends, economic conditions, and historical data. Moving on to the demographic assumptions, these assumptions account for workforce behavior and employee longevity, which impact benefit obligations. Under the demographic assumptions lies mortality rate, attrition rate, and the normal retirement age. Mortality rate is the likelihood of an employee surviving to receive benefits, often based on standard mortality tables. Attrition rate is the probability of employees leaving the company before the retirement age. And the retirement age is the typical retirement age based on the company policy or the industry norms. Now, setting the right assumptions is crucial because they directly impact the liability estimates. They must be unbiased, consistent, and economically sound. In short, well-researched and well-set assumptions enhance the reliability of the valuations, ensuring more accurate financial reporting and informed decision-making. Now let's understand how these assumptions are determined. As per the best practices, assumptions should be both biased, unbiased, and mutually compatible, meaning they must be neutral, data driven, and reflect logical economic relationships. For example, rising interest rates should correspond with higher salary growth rates. Further, to ensure objectivity, assumptions should be based on historical trends, industry benchmarks, and expert judgment rather than just rather than using them to just manipulate an outcome to achieve a desired financial position. Now, the main question is, how are these assumptions determined and what we can do about it, right? So let's delve into the details piece by piece. First, the discount rate assumption. As discussed in the last slide, it is used to determine the present value of future benefit payouts. It is set on a mark-to-market approach. The discount rate should be aligned with market conditions at the valuation date. Typically, the discount rate is derived from yields of high quality corporate bonds or government bonds. Further, it is crucial that the selected discount rate matches the currency and the duration of the benefit liabilities. For instance, long-term liabilities like an end of service benefit should be discounted using long-term bond yields to ensure an appropriate match. Now, moving on to the salary growth rate assumption. As discussed earlier, for defined benefit obligations like an end of service benefit, future salary increases must be projected accurately. A higher salary increase lead to higher liability estimates. Now, salary growth rate is determined using various factors. First is the historical trends. Looking at past salary trends within the company helps in making reasonable projections. Let's say if the company has consistently provided 7 to 8% annual salary hike to their employees, it would be unrealistic to assume a salary growth rate which is very much lower or higher than this trend. Then second factor is management's future expectations. Now, CFOs and HR teams should align actuarial assumptions with internal salary growth policies. For example, if the company is implementing cost-cutting measures or a hiring freeze, future salary growth rates may be lower than expected. Then the third factor is expected future inflation. Inflation has a direct impact on the salary increments. Higher inflation environment often lead to higher salary growth assumptions. Fourth factor is promotions and career progression. Companies with a structured career progression plans should factor in additional increases due to promotions. For example, industries like IT sector, consulting sector see faster career progression, leading to a higher overall salary growth rate. Now, moving on to the third assumption, which is the attrition rate, or you can say employee turnover ratio. Like salary growth rate, attrition rate is also determined using the company's historical trends and management's future expectations. For example, if the company has seen a 10% annual attrition rate for the last 5 years, this serves as a strong indicator for future projections also. And if the company anticipates layoff, restructuring, or slowdown in hiring, the attrition rate may be higher in that scenario. In addition to this, one should also analyze the industry and market trends here. Certain industries experience higher attrition rate. For example, startups and IT sectors have typically higher attrition rate, whereas public sectors have typically lower attrition rate. Moving on to the fourth assumption, which is the mortality rate. Now, mortality rates are generally based on the standard mortality table issued by the regulatory bodies or the industry associations. However, allowances should be made for longevity improvement here. Like rates can be adjusted to account for increasing life expectancy. Medical advancement and lifestyle changes will also impact the longevity trends. Also, industry and sector specific adjustments should be made. Certain professions have higher mortality risks, example, mining and construction workers. On the other hand, white collar professionals generally have lower mortality rates. So those adjustments need to be made while deciding the mortality rate. In a nutshell, selecting actuarial assumptions require careful judgment and alignment with the financial strategy. Companies should collaborate with their actuaries to ensure accuracy, which will reduce audit queries and financial surprises. A data-driven, well-calibrated approach leads to reliable valuation and informed decision-making. Now let's move on. Here, we'll discuss the sensitivity of actuarial valuations to the key financial assumptions, which are salary growth rate and the discount rate assumption. On the left, we have the discount rate assumption. A lower discount rate increases the liability, resulting in a higher expense for the company. And conversely, A higher discount rate decreases the liability, reducing the reported cost. On the right hand side, you can see there is a salary growth rate assumption. A higher salary growth rate leads to higher future benefits, inflating the actuarial liabilities. On the other hand, a lower salary growth rate means lower projected benefits, reducing the actuarial liability. Now, these assumptions play a critical role in financial reporting. Even small changes in these assumptions can have significant impact on the liabilities. That's why it is essential to set them realistically and review them regularly to ensure accurate valuation results. Now, these projected liabilities are also influenced by attrition and mortality rate assumptions. However, in the case of, say, attrition rate, the impact on liability is not always straightforward. An increase or decrease in attrition alone does not directly indicate a rise or fall in the liabilities. Other factors such as financial assumptions, retirement age, and overall workforce composition also play a crucial role in determining the actual effect. Now, moving on, let's discuss the valuation methodology, which is used to calculate the employee benefit obligations. Now, the method prescribed by IS 19 for actuarial valuations is the projected unit credit method, which is the PUC method, also known as the accrued benefit method. This method calculates the present value of future of projected accrued benefits as at the valuation date. The PUC method works by allocating the total expected benefit cost over an employee's working life. Instead of recognizing the entire liability at once, the method attributes a portion of the benefit to each year of service. This ensures the cost is accounted for in a systematic and fair manner, aligning with the financially reporting standards. Now, it essentially considers each period of service as a separate unit of benefit entitlement and value them individually based on their current salary, years of service, and projected future salary increases. This is illustrated by the timeline also here at the bottom of the slide, which represents expected future cash flows arising from these obligations at different points in time, which are marked in yellow, leading up to the employee's retirement. Here, the two critical assumptions that influence the calculation are the salary growth rate assumption and the discount rate assumption. Now, future benefits depend on how the salary increases. If the salary grows at a faster rate, future liability will also be higher. Similarly, the discount rate, why? Because since the benefits are paid in future, we adjust their value to today's terms using a discount rate. A higher discount rate reduces today's liability, while a lower discount rate increases it. Now, in a nutshell, the PUC method is an internationally accepted approach that aligns with the accounting standard, ensuring a fair allocation of benefits across an employee's service period. By carefully selecting actuarial assumptions, organizations can accurately project their long-term liabilities and ensure financial preparedness for employee benefit payouts. Now, moving on, let's take a very simple example of end-of-service benefit valuation to understand how the liability is determined. This is a very simple classic example of an EOSB scheme in which the benefit is payable as per the Saudi labor law. We have captured all the details required to value the liability. Now let's walk through a simple example of EOSB valuation to understand how the liability is determined. We have an employee here who is 50 years of age, whose current monthly salary is 5,000 SAR. He has already rendered 8 years of service. Remaining years to retirement is 15 years. Right. Now, if you will see how the accrued liability will be calculated, it will be 15 days of salary per completed years of service for the first 5 years and full month of salary for the remaining years left, which is 3 in this case, multiplied by the total salary of the employee, which is 5,000 SAR. Hence, the total benefit, total accrued liability comes to be 27,500 SAR. For the sake of simplicity, currently we are assuming that there is no mortality and there is no attrition. Now let's understand how the actuarial liability will be calculated and how the POC method works here. Here we project the liability forward using actuarial assumptions. Right now we are standing at age 50 and time 0. You can see from this example, and the retirement age is 65 for this particular employee. So the cash flows will be built for the next 15 years. You can see employee has already rendered 8 years of service. So the total service for this employee for the first year is 8 years, then 9 years, going up to till 23 years. Projected salary increases by the salary growth rate, which we have incorporated every year. This makes that at the time of retirement, his salary would be 10,395 SR. So the expected benefit payout shall be half month salary for each completed year of service for the first 5 years and the full month salary for the remaining years, which is 18 multiplied by the total salary, which you can see on the screen, which is 2,13,090 SR. Now, how the present value of obligation is calculated? The projected unit POC method say the liability will be recognized for the only for the services rendered till date, till the current valuation date, which is 31st December 2024. In this example, you'll see total expected payout, which is 2,13,090 SR, will be multiplied by the service rendered by the employee till date, which is 8 years, and divided by the total service of the employee, which is 23 years. And we arrive at 74,118 SR. Now we discount this to the current date to arrive at the present value of obligation and arrive at the liability of 29,853 SR. Now we have prepared a similar example for the UAE law also, but I am afraid we are running short on time. So I will give you guys a minute to go through the structure, which is very simple. In case of a UAE law, we are saying that if an employee has covered less than 1 year of service, he will not be payable for any benefit. If he has covered 1 year, less than 5 years of service, he'll be eligible for 21 days salary for each completed year, and above 5 years, if he has served for the very first 5 years, he will be eligible for 21 days salary for each completed year, and for the remaining service, he will be eligible for 30 days of salary for each completed year. Here we have extended the same example that we have taken in the KSA labor law example. We have calculated it using the UAE law. You can see that the accrued benefit is calculated here, followed by the total expected benefit payable, which arrives to be 2,23,485. Then we have calculated the actuarial liability, which is first we prorate the benefit and then we discount it to the current date and arrive at a liability of 33,844 AED. If you have any questions here in this slide, happy to answer that at the end of the webinar.